So we're talking about retail, online retail out of China. It seemed like everything looked pretty dang impressive, Mark, but there is one little stat within this whole thing. They had a mixed report. The revenue, it was only up 86%, that's all. And yet that wasn't even enough, as it turns out. They were slowing supposedly on this as well. The marketing and the transaction, that's all going in a great way, in the right proper way. Expenses, though, you take a look at the expenses, that's where the problems do step up. And then suddenly you look at that, that's up 48%, those costs. So when I look at this one, but here's the other crazy part. When you really dig deep into PDD, you've got free cash flow. It's only 95 billion. Cash to debt, 231 billion. So they do have some growth, Mark, but I guess that number, the number we were looking at for expenses kind of spooked people because stock's down about 30%. I think that's a great opportunity.
Yeah, I mean, listen, it may be I am a little bit more sanguine when it comes to these Chinese names for a whole host of reasons we won't get into. I think the other undercurrent that's not been mentioned in conjunction with this story is there is continued weakness in the Chinese consumer, especially when it comes to discretionary retail. Those folks are spending money on what they need, not necessarily what they want, and that's an evolving story. So I think any of these Chinese retail names, they sell globally, of course, but a lot of the core strength comes from the domestic retail, and that is a weak area in the Chinese economy right now.